Hello traders, it's Victoria from TRADEPRO Academy, and I hope everyone's super excited for this video because in today's video we're going to be doing something that a lot of people have wanted to do and a lot of people probably have done before, but it is going to be squashing the beef and the debate between is the SPX a better option to trade than the SPY for day traders, right? Which option is better to trade, SPX or SPY? Let's hit that subscribe button, hit that like button, and drop that little notification bell for when we drop videos like these and go live. Now I'm going to break down the two individually, right? The SPX versus the SPY, and we're going to put each of these up on the screen. We're going to keep up the SPX so you can relate it to the SPY and see how they compare. Now, the main thing here is the SPX and the SPY, they both pretty much track a very similar thing, right? In different ways, right? They both track the S&P 500 index. And that is something that's traded very, very often and is super liquid, making both these options very viable to trade in terms of liquidity, in terms of movement and opportunity. So let's break down the SPX first. We're going to break down what it is, and then we're going to go through the SPY, see what some of the differences are, see what some of the pros and cons of trading each are, and then break it down with my final decision on which is better. The SPX itself is based on the S&P 500 index. So what that means is completely derived from the index. If you go and take a look at the index, if you just try to type in S&P 500 index, usually the ticker symbol associated with that is the SPX because you cannot actually trade the S&P 500 index itself. Now, the SPX is also a European style option, meaning that it can only be assigned at expiration. In comparison to an American style option, which can be assigned before expiration, this really limits the ability of the SPX with the European style expiration. Now, the SPX also has no dividend yield, so you don't have to factor that in when you're trading on trading days and when you're trading the options themselves. The SPX is also cash settled, meaning that typically with options, like Apple, for example, on expiration, there's usually assignment if you're in the money, right? That means that you get assigned, right? You either receive or owe X amount of Apple shares. That's the same thing with other stocks, but the SPX is different. The SPX instead into assignment, what you're going to be assigned is you either receive or you owe a certain money, which is the difference between the options pricing contracts and the underlying asset itself. Now, the SPX spreads are usually a little wider, between $5 and $10, and can range even more. They can be even wider than that, meaning that sometimes it is a little harder to get filled and there might be a little trickle of liquidity issues, even though it's very heavily traded and there's a lot of contracts that are floating around. If you take large positions in contracts, right, with the SPX, it might work to a pretty big disadvantage if you're getting into market orders in the option itself. Now, they're generally more expensive than the SPY, right? SPX contracts can be 10 or more times more expensive than the SPY, depending on time, depending on the contracts you choose themselves. And that's because the SPX is denoted at a larger increment than the SPY is. And then finally, the SPX, they do have daily expiration. So if you want to trade 0 days to expiration, right, if you want to take those lotto trades in, you totally can with the SPX any single day of the week. Now, if we compare this with what the SPY has, we'll get a better understanding of what's going on with the two. Now, the SPY in contrast, right, the SPX, it was denoted and it is based on the S&P 500 index itself. Now, the SPY is an options contract based on the SPY ETF, which is then based on the S&P 500. So we're going into a few different steps here and kind of diving into the rabbit hole instead of being just straight up based on the S&P 500 index. Now, SPY options, unlike their counterpart, the SPX, they are actually American style options, meaning that on expiration or before expiration, you can assign an option, which you cannot do with European style options. They also do have a dividend yield, which is something that you do have to take into consideration when you're trading options or the stock itself. And like other stocks, they are physically settled. By that, I mean that you're actually transferring the shares themselves rather than a cash settled like the SPX. So you either receive or you owe shares depending on how the options expire in the money, right? If you're in a position that expires in the money, or you even get assigned before the expiration, you may have to deliver or receive shares of the SPY depending on if you have puts or calls. The liquidity issue with these is that there's usually no liquidity issue. The spread is super tight on the SPY because they are a lot cheaper. They're a lot cheaper options and usually get $1 to $2 spread, and they're very liquid. A lot of people actually trade them. And as of November 2023, the SPY actually has 0-day expirations every single day. So technically they can expire every single day like the SPX. That was one of the disadvantages of the SPY, I would say, before November 2023. Now, as you can see, there are some clear advantages and disadvantages. For example, the SPY is more liquid in terms of the spread. It is cheaper, so you can trade more contracts, you can trade larger size, and it's better for newer traders. The SPX, on the other hand, right, it is a little less liquid. It is based on the S&P 500 futures themselves, and it is based on the S&P 500 index itself, and they're European style options, so you can't get assigned before the expiration. Now, they are a little more expensive, right, depending on what kind of options you trade, so on and so forth. But there is one key thing that will differentiate the two of these. Now, for example, you might be thinking, well, I could just trade 10 contracts of the SPY versus 1 of the SPX, or 5 of the SPY, 1 of the SPX, depending on what kind of options you select and depending on the actual pricing of said options. Now, you think that you might be able to get more contracts in the SPY and have the same returns, and you have more freedom to actually get out of trades and layer out and layer into trades because they're cheaper and you can buy more of them. However, here's one key thing. The SPX actually has larger returns in general than the SPY, right? The movement on the options themselves, right, are a little more volatile, so the actual gain is a little better. Let me show you one example here. This is the main thing because the risk is very similar. This is the main thing when it comes to options and the SPX and the SPY. The return on the SPX is more favorable than that of the SPY if you choose the exact same options contract. They have different IVs, they have some different deltas, but it's pretty much the exact same options contract. One obviously is a lot cheaper, being that the SPY, so you can buy a lot more, but the gain on the SPX is a lot more handsome. That is the kicker for me, and that's why I'm going to choose the SPX. Let's take a look at this comparison. With the SPY, we're going to be buying the 397 calls. With the SPX, the 3970 calls. Right? The 3970 calls are about $2.50 on the SPX here up on the screen, and the SPY, they're about 30 cents at the low. We're talking about the low peaks and the top on that massive rally to the upside. Now, the SPX runs to about $13.50. The SPY runs to about $1.30. Now, $1.30, right, that whole gain on the SPY is about 333%, which is a great return. However, that same movement is, again, bigger on the SPX, 440% about. So you get over 100% difference for trading pretty much the same asset, a very similar asset within each. You can buy many more contracts of the SPY, but the net return is going to be much larger on the SPX, and so seemingly the dollar denomination. So when I'm trading these assets, right, I can trade SPY from time to time, depending on maybe I want more contracts, right? And I'm okay with taking less of a return. Maybe I want to risk even less because the risk on the SPX, especially 0-day contracts, they're going to whipsaw like crazy. If I'm swing trading, we're not even talking about day trading anymore. If I'm swing trading, I'm going to be trading the SPY because they're cheaper, they're very liquid, and we can easily get in and out of those contracts at a much lower cost and increase our trade size in comparison to the SPX. So with that being said, I'm a fan of the SPX when it comes to day trading options compared to the SPY. So I want to put that debate to rest. Go and check it out for yourselves. Which one has better returns for very similar risk, right? They each have their pros and cons, but if we're talking about net returns, I'm going to have to stick with the SPX. Yes, I might have less contracts, but, right, you sacrifice some things for greater returns. That being said, I want to wrap up this video. I hope you enjoyed this video, you got some insight on it, and I want you to drop a comment down below. If you traded SPY over SPX before, are you going to reconsider? Are you an SPX trader? Now hit that like button, hit that subscribe button. We're going to see you guys next time.